So, where we left off on Monday, we had talked about the financial statements, right? Um, in this diagram, we can see the basic flow. There's an order to them because they're all building on top of each other. Okay, so we see that from the income statement, right? We have certain accounts that are going to be presented there. Okay, we have the revenues. So remember, there's going to be different types of revenues. Um, maybe there's going to be sales revenue, service revenue, interest revenue. You're going to have whatever revenues you have. You're going to have all your expense accounts. Okay, so you're going to have rent expense, utility expense, salary. You're going to then take the revenues minus the expenses and get how much profit you made. We also call this net income. Okay, now we have the net income flow into another financial statement. Okay, so I showed you Google's in the book in your homeworks for now. We have a very simple kind of financial statement called the statement of retained earnings, where we have all the retained earnings from all the prior periods, right? Let's say you're looking at this is the financial statements for 2025. So, and let's say our business started in 2001. So from 2001 to 2024, you're going to have some retained earnings. That's going to be your starting balance. You're going to see what happened in 2025, how much net income. So this is the income statement for, again, 2025. You're going to add in the net income that you earned from this period. You're going to subtract whatever dividends you paid, and that's going to give you the ending retained earnings balance. So this is going to be as of December 31, 2025. Now this balance sheet, as it says here, it's at a point in time. So this balance sheet is going to be showing our accounting equation, assets equals liabilities plus equity. The claim was that this balance is true at every moment after every transaction. So you would expect as of the end of the year, December 31st, 2025, it's also going to balance. So that's what this balance sheet is going to show. It's going to show all the assets, liabilities, and the total equity balance as of this cutoff date, December 31st, 2025, as of a particular day. Okay? And so this ending retained earnings balance is going to be part of this. It's going to be part of this equity balance. Okay? So they all are flowing together. One piece of the income statement goes to the statement of retained earnings. That balance goes to the balance sheet. And really the balance sheet is like the main one because it's showing this balance of assets equals liabilities plus equity. That's what the balance sheet is. It's showing the balance of this equation. Okay? So, um, maybe let's look at one more real company, just to remind you. So this is CoreWeave. They do, they're like a server, they provide these data centers. So let's see what they got here. Okay, so these are their the main financial. So this is their 10Q. 10Q stands for their quarterly financial statement kind of reporting. Okay, so since they're a public company, every quarter they have to provide the public their financial statements. Okay, and then every year they have a more extensive, fully audited annual filing, okay, called a 10K. So in this case, they're calling the income statement the statement of operations. Okay, but as you get more familiar with uh, looking at real financial statements, this is the income statement. Okay, because you can look at it. What does it have here? It has revenues minus all their expenses. Okay, so that's what an income statement is. They're calling it something a little different, but you can just tell from what information is displayed that this is their income statement. They're just, they've titled it a little differently. Okay, so you can see that they're making a net loss Okay, so their revenues are 1.3, I'm assuming billion. This is for a quarter, so 3 months. And their total expenses are a little under that. So they're making what we call an operating income, but then they have a bunch of other stuff. So you can see this. This is their interest expense. Okay, so even though they're making a little bit from just their operations, the fact that they borrowed money and have interest due, that's making them unprofitable. Okay, so you can see that they have this net loss. Now, if we go to see, no, what is this? So this is their, you can see accumulated deficit. Okay, so they've never made a profit. So there is no retained earnings, right? Retained earnings, you think about that word, you're assuming that there had been some profit at some point, but this company's always operated at a loss. So they're calling this column accumulated deficit. And you can see that the net loss from this period is added to the all the other losses that they've taken on all the previous kind of history of the company. Where is it? Going backwards in time. Yeah, this is 23, 24, 25. Um, okay. Well, anyways, yeah, we'd have to. There's a lot going on here because this is probably a company that took. You can see they have different series of equity that they've taken as paid-in capital, contributed capital, and they've never earned any money. So, but basically, if we spend enough time, we could figure out there's like this total equity balance is going to be in their balance sheet. So if we now go to the balance sheet, they have a lot going on here. Mm. Um, okay, so the total assets is this 17.8 billion, right? So they have cash, um, a lot of cash, 1.3 billion. Their biggest asset is their property, plant, and equipment because, as I said, they're a provider of like kind of data centers, and so they own a bunch of property, they own a bunch of servers, and so that's what this 12 billion dollars is. So it's their largest asset. So their total assets is 17, and then um, their total equity. We would have to find this. Maybe I should have done a little better job of looking through that beforehand. But you can see that it balances. Okay, the point is that this total assets is equal to their total liabilities, redeemable convertible preferred stock, and shareholder equity. So this is a fancy way of writing their liabilities plus equity. Okay, so it balances. Um, yeah, I think we'd have to spend a little more time because they have a lot going on in their equity section. They have uh, convertible stock. They got a lot of noise in there. But if we spent the time and like to decipher this, this balance is gonna hold true. Okay, that's what the balance sheet is gonna show. Okay. Um, so I think what we should do now, and this is obviously like a very complicated company. They have a complicated uh, capitalization, right? The borrowing, their equity, how they finance their business is not very uh, straightforward. So it takes some time to decipher what's going on. But we're gonna practice doing a very simple example where we have, and you can open your Excel sheet that we had um, from last class. And so you have this photography company. Um, it's telling you that you had a starting balance of retained earnings as of the end of the previous year, which is the same as the beginning of the current year. And then at the end of 2025, so we see again, just to highlight here where my cursor is, 16,000 as of December 31st, 2024. So that's the previous year. Now, at the end of the current year, you have all these balances, okay, for all these different things. So you have some expense accounts, you have cash, which is what? Is it an asset? Is it a liability? Is it revenue? Is it an expense? What is it? Asset. Okay, so what financial statement is going to go on? Balance sheet, right? What about expenses? What financial statement does that go on? Income statement, exactly. Okay, so your job will be to go through each of these, figure out what financial statement they're going to go on, and organize the financial statement. So you're going to start with the income statement. So you're going to want to find all the revenue accounts and all the expense accounts, put them into this income statement, find out how much profit was generated. Then you're going to do the statement of retained earnings, where you have a beginning balance of retained earnings. You add in your result from this income statement. You subtract the dividends. That will give you an ending retained earnings balance. And then you're going to do the balance sheet. You're going to list all the assets, all the liabilities, uh, all the contributed capital, and then add in the ending balance of retained earnings, which you calculated in this statement here. Okay, so you're going to now have to apply kind of, really the challenge will be to figure out which of these accounts goes where. Okay, so this will be a test to see if you remember that revenues and expenses go in the income statement, dividends are going to go in the statement of retained earnings, and then assets, liabilities, contributed capital go in the balance sheet. Okay, so I just kind of told it to you. Now try to see if you can apply it here and get the balance sheet. You'll know you did it right if your balance sheet balances, meaning your assets, the total assets equals the liabilities plus equity. And if you've done the other two financial statements correctly, everything will balance at the end. Okay, so why don't we take some time? I'm going to turn on the lights and you guys can start working on this. Okay, so look, you had to go through here. I'll say it again. It sounds like maybe some of you didn't get this. We have certain classes of accounts. We have asset accounts, we have liability accounts, and we have equity accounts. But within equity, there's a bunch of stuff, right? We have contributed capital, right? Common stock. That's the account that we have for contributed capital. We have revenues, we have expenses, and dividends. Okay, so within equity, there's a lot of stuff. Okay, so basically, you need to go through this and figure out what is an asset, what is a liability, what is a revenue, what is an expense, what is, dividend is obvious. It just says dividends. And the common stock is contributed capital. Okay, so um, maybe I need to show this schematic again. Okay, I think people are a little lost here. If you remember this, I told you guys to memorize this table, right? What we're doing is trying to work our way from the bottom of this up to the top, which is what is our main accounting equation? Equals liabilities plus equity. So in order to get to there, we need to first figure out our balance of equity, because there's a lot of details going on there. So the income statement is starting off with just the revenues minus the expenses. Okay, so this is the first financial statement that we're compiling here. This will give us a result that we will combine with what is going to go here. Anyone remember? Dividends, yes. Okay. So look, we already got this net income from the income statement. We combine it with dividends to get retained earnings. Okay. So what is this blank here? This is going to be on the quiz. I told you guys to memorize this. So what is it? What are the two parts of equity? There's retained earnings and what? Contributed capital. Okay. Once you have this, This is just common stock, and you can complete your balance sheet because you'll have all your assets like cash, accounts receivable, you'll have your liabilities like accounts payable, and now you have this, right? Because you've done these kind of lower steps to lead up to this, and you can then make your balance sheet. Okay, so the balance sheet um, is just, you've basically gone through the steps to figure out what your equity balance is, and then you combine that with your asset and your liability accounts, and you then have the complete kind of set of things that you need to balance your equation. Okay, so um, now going back to our sheet here, so we're going to start at the bottom here. Okay, revenues minus expenses. So if I go through here, I can see insurance expense, obviously an expense. That's going to go on the income statement. Cash. No, that's an asset. That's going to come all the way at the end when we compile the balance sheet. So I don't need to worry about that. Accounts payable. That's a liability. Also at the end, it's going to be on the balance sheet. Advertising expense. Yes, that's going to be on the income statement. Because again, the income statement is only the revenues minus expenses. Okay. Service revenue. Yes, that's a revenue. Okay. So I'm going to start at the top here. I'll just say revenue. Okay, and I only have one type, service revenue. And I'm going to say it's 80,000. Okay, and I can make the numbers look nice. This is all like little details in Excel. If I right now it's just kind of like this unformatted number. If you go up here to this little dollar sign, if you click on that, it formats it into dollars. And you can see I highlighted this whole column or all these cells. And when I do that, it's going to make all of them into these dollars. And then I personally don't like to see the decimal points. So if you go to this little button here, you can click that and it gets rid of those decimal points. Okay. And I can just see that it's the only revenue. There's no other revenue. I can quickly go through here, all these other accounts. There's no other revenue accounts. So that's it. So now if I have my expenses, what do I have? I have insurance expense, 6,000. I have cash. No, I don't need to worry about that yet. Accounts payable. No. Advertising expense, 5,000. Okay, dividends. No, I don't got to worry about that yet. Accounts receivable, that's an asset. I don't need to worry about that. Notes payable, that's a liability, also not on this financial statement. Salary expense. This though is an expense, 25,000. Okay, and if you want to make all these the same size, they're all kind of different sizes and different fonts, so you can make it kind of look nice. Okay. Um, And then I can do a total here, okay? Because look, this is like writing a report, like if you do a presentation, you want it to look nice, you want it to be formatted nicely. So, you want to make it look a little nice and have some subtotals and stuff. So I can do total expenses. And again, I can use this sum formula. So again, equal sign, SUM, parentheses, and then you can just highlight these three cells that I want to add up. Okay. And so now I am ready to calculate my net income. All that is, it's equal to my revenue. And then in Excel, so you can see I did a cell reference. Okay. I, I did equal sign and then I just pointed to this cell and it says J14. It's like a grid. You can see it's column J, row 14. Okay. Minus this cell, 36,000, J20. Okay, 44,000 is my net income. Now, the reason why we use cell references is let's say I made a mistake. Actually, advertising expense was 8,000. I could just change this number. It will automatically update everything, right? It updated this total expenses and the net income. So by using functions, by using cell referencing, you can have a dynamic spreadsheet. It's going to dynamically change. As you change one thing, it's going to change everything else that's dependent on that. And that's one of the big uses of Excel, why it's such a helpful tool. Okay, so I would get in the habit of using the formulas and cell referencing instead of hard coding numbers. Sometimes you had to, right? Like I hard coded 80,000, but wherever I could use a cell reference or a formula, I did. Okay, so now the statement of retained earnings, you're going to have formatted this as beginning balance, add net income, subtract dividends to get your ending balance. Okay, so now it gave you this information. We just calculated this. The dividends is another account. You can see the balance there, and then you can just use a Excel formula to find the ending balance. Okay, so go ahead and do that. And then if you finish that, move on to the balance sheet. Okay, so it should be pretty simple. It's, let me just fix this, make it look kind of nicer. They're all different fonts and different sizes. So I'll just fix that. Okay, beginning balance. If I look up here, the balance of retained earnings was $16,000 as of December 31st, 2024. All the information that we see is for 2025, what happened in the year 2025. So my starting balance of retained earnings is the same as the ending balance of the previous year. So it's telling me that the ending balance of 2024 is 16,000. That is the same thing as my beginning balance of 2025. Okay, so I'm going to start with the beginning balance of 16,000. I'm going to add, in 2025, I earned $44,000 of net income. I just calculated that from this income statement. So I'm going to do a cell reference to that. I see that my dividends that I paid was 13,000. Okay, so that's a subtraction from retained earnings, right? Our retained earnings, the definition is your profit minus what you've paid out in dividends. So I've paid out 13,000, and let me format all these nicely into dollars. When you see a number with parentheses around it, it means it's a negative. Okay, when it's like formatted as a dollar. And so all I can do is now add these up. The 13,000 is already a negative. I don't need to do I don't need to, I can just add, when you add a positive number with a negative number, it subtracts the negative number, right? So hopefully we all remember that from like whatever 7th grade math. So I'm just going to add all these up, and that's my ending balance for retained earnings. Okay. So now for the balance sheet, I'm going to list all my assets, cash, I had accounts receivable, and you have the balances up here, 37,000, so on and so forth. So I'm going to list my assets. You're going to list your liabilities, which I think you have a couple of them. Accounts payable, notes payable. We just calculated this question mark. We just calculated the retained earnings balance as of the end of the year. We just calculated here. Okay, so now you have everything you need to complete your balance sheet. Okay, so go ahead and try to do that. I guess I'll leave this up. By the end of this exercise, every account here should have been incorporated into some financial statement. Okay, so you can go through and make sure everything in there is accounted for. Okay, so look, I understand there's some misunderstanding about this idea of retained earnings. Okay, revenue, expense, dividend. So I'm just going to make up some hypothetical numbers, okay? Okay, so look, here's 5 years. If my company's existed for 5 years, okay, this is the revenues, expenses, and dividends. If I added up all the revenues I've ever earned, if I added up all expenses I've ever earned and all the dividends, and then I figured out what my ending retained earnings balance is, revenues minus expenses minus dividends, 9,000, right? It's the same thing. Okay, so this is the sum. If I just add it up since the beginning of time. Now, another way I could do it is just every year, okay? Revenues minus expenses minus dividends. This is my ending balance. And then the next year, I take my balance from the previous year, I add up the revenues minus expenses minus dividends. And I just keep doing this till the end. I get to the same answer, okay? So what we're doing is we're not ever presenting our financial statements of like years 1 through 5 of the business, right? We're only presenting this latest year. Okay? So what we are doing is we'll take the ending retained earnings balance from the previous year and just update it as to what happened in the most recent year. Okay? Does that make sense? You'll get to this exact same ending retained earnings balance, but because we don't present the financial statement, this is like financial statements years 1 through 5, but we don't do that. We only care about in year 4, we're going to take the ending balance of year 3 and update it. And then year 5, we take this ending balance and update that. And we just keep updating it. And it's the same number as if we just had one big, like since the beginning of the company until the present moment, it's going to give you the same result. Okay, so if you did not include this $16,000, right, then it's like all the previous years just didn't exist, right? This $6,400 is a summary of the entire history of the company, all its revenues, expenses, and dividends summed up, netted against each other into one number. And so you need to include that because you're updating that number with whatever happened in this most recent year. Okay? Okay, so let's continue. Let's just finish this. Okay, so I started with the cash, accounts receivable, 8,000. What other asset did I have? What was that? Equipment. How much did I have? What was my balance? Okay, 50,000. Okay, and I'm gonna format this, make this all nice, make these dollars. Okay, and then so my total assets, I'm gonna use the sum function and add these up. Okay, so now what are my liabilities? What were they? Accounts payable. Well, how much? 2,000? 7,000? Okay, what else? Notes payable, 12,000. Okay, and where are we getting this? Let's just look up here, just so we're clear. Notes payable, 12,000. Accounts payable, 7,000. Okay, that's where these numbers are coming from. You just had to have had the understanding of going through this list of accounts and understanding which ones were liabilities. Okay, so these two are the liabilities. Yes, I agree. So our total liabilities, again, I'll add these up, make these look nice. Okay, and now In equity, we have two parts of it: contributed capital and retained earnings. Contributed capital is our common stock. This is when we sold shares of our business to investors and they gave us money in return for that. That's what this common stock account represents. So if we go back up here, we see common stock, 29,000. Okay, and then we have retained earnings. Where do we get that from? This is as of end of the year, 2025. Where is that? Is that up here somewhere? Statement of retained earnings. We just calculated this. This is for 2025, the ending balance as of the end of the year, because we took the January 1st balance, we added whatever net income we earned in 2025, we subtracted what dividends we paid in 2025, and this is our ending balance as of the end of the year. So that's going to basically go here in this balance sheet. Okay, so now we add this up. So total equity equals the sum of these. Okay, so now I can do total liabilities plus equity is equal to this plus this. And lo and behold, total assets equals total liabilities plus equity. Our accounting equation we've just proven is balanced as of the end of the year. Okay? So the key things to remember is you need to understand what types of accounts go where. The income statement is going to be revenues and expenses. The statement of retained earnings, you'll take the result of that and incorporate the dividends. And then all your assets, liabilities, and contributed capital go on the balance sheet, along with that retained earnings balance that you calculated. Okay? Okay, why don't we take a couple of minutes? We'll take a little break, and then there's like one little part of chapter 1, and then we're going to move on to chapter 2. Okay, one financial statement that we're going to spend an entire chapter on this one, okay? But it's worth mentioning because it appears on your homework. Okay, quiet down. We're going to restart class. And this is important because it's on your homework. And so I'm just going to mention this financial statement. We're going to spend an entire chapter on it later, as I mentioned. But basically, it is all an entire financial statement dedicated to cash, okay? Where we see here on our balance sheet, we see that there's a movement here from the end of this year to this quarter in 2025. The cash balance changed. Where did that cash go? Okay, there's an entire financial statement called the statement of cash flow that's going to take you from this balance and shows you what cash came in, what cash came out, and how this ending balance of cash came about. Okay, so just high level. Okay, you can see that it's taking reconciliation with cash. So there's basically 3 sections to it. It's going to have the statement, like it's going to take the net income. It's going to do a bunch of adjustments to it. And again, this is why there's a whole chapter on it. It's like quite complicated. And it's going to, yeah, this is so, okay, so net cash for, so the first section is operating activities. So this is just cash that the business brings in minus cash it spends on kind of its like expenses. Okay, so this is one section. Another section is on investing activities. So this is all the things that it buys, all the assets it buys, and then all the assets it sells. How much cash goes in and out of that, and then financing activity, which is if it's selling stock, if it's borrowing money, if it's paying off debt, how that cash flows in and out. Okay, so it's just looking at the cash inflows and outflows. Okay, and we learned that you can have revenue on your income statement, but have no cash flow from that. How is that possible? If you generate a sale, is the customer always going to pay you cash right away? No, right? You can have an account receivable, right? So this statement is cutting through all of that and just looking at how much cash is coming in and coming out. Okay, so the income statement, it can be, you can have a lot of fake sales going on if you have a lot of account receivables and other stuff. But this is just cutting to the straight cash inflows and outflows. Okay. Um, and I think, part of your homework, a kind of easier question is asking you about this. And you may just have to refer to the book because we just don't have time. And again, we're going to learn about this chapter in like full detail in chapter 14. Okay. But for now, I think it's just important to know that cash is here, dividends, right? All the dividends that you paid, it's going to be in this. Again, this is probably the wrong one to be looking at. There's so much stuff going on with their um, financing. But if we look close enough, and they probably don't pay a dividend because they're like a loss generating company. So maybe I need to look at Google. But the dividends will be included in the financing activity somewhere. Okay. Um, okay. So the last part of chapter 1 is at the end of every chapter, pretty much, there's like a financial ratio that they talk about. Okay. And the one in chapter 1 is called return on assets. And it's basically trying to answer this question: how effective is the company at using its assets to generate a profit? Okay. So uh, here's a thought experiment. $100, let's say two companies make $100 of profit. If one company is employing $1,000 of assets and one is employing 1 million, which company would you rather own? They're both generating the same dollar amount of profit. Yeah. In the corner, what's your name? Kylie. What do you think, Kylie? The one, why? Yeah, exactly. It's what we call more capital efficient, right? Yes. Uh, you want a business because that $1 million of assets, it had to be paid for somehow, right? You either had to bring in investors and split the profit up in between more people, or you had to borrow money. It was more difficult to generate that $100 because you needed way more assets and therefore a higher cost of capital than generating that $100 from a much smaller capital base. Okay, so this metric of capital efficiency is important to an investor, right? You, as the owner of a business, want as much profit for as little of your own contributed capital as you can, right? That's why, like a software business is like so, uh, it's like they're so valued, right? Because what do you need to run, WhatsApp? I think got acquired for like 20 billion. What do they really need to run that business? They just needed servers, which they were renting. They didn't even need to own that. They were just paying Amazon some rent for that. So what did they actually need to own? Really nothing. They could have rented everything, right? So that's an example of, it was like, I think it was like 20 to 50 employees when it got bought out. It required very little fixed capital. Uh, they just needed some engineers sitting in a room, really. Okay, so that's like the quintessential capital light business where you can have this huge business running off of very little capital. Because those engineers could have just gotten together and not raised any money. They didn't need to split ownership with anybody, right? But if you're running like a car factory, you as the owners are going to have to bring in lenders. You have to bring in partners that are going to put up money, and you have to split the profit with them, right? So, so this metric, return on assets, is trying to quantify this capital efficiency. Yeah.
the company has just started its existence,
Yeah.
6 months, right?
Yeah.
The beginning would be zero, the end whatever. So we still use the average.
Yeah, so this is why it's not accurate too, because your average total assets is like it's kind of arbitrary just to take the average between the beginning and ending balance because it's changing every moment, you know?
The book had that kind of exercise, but they failed to provide the answer. It was an error in the book.
What
To figure out.
Yeah, so all of this is just approximations, you know? For mature businesses that have like a relatively stable asset base, this is like a good approximation, but it is an approximation. What you'd really need is like a weighted average, you know, or like some kind of uh like a day if you had the daily asset balance, like taking the average of that. But yeah, this just taking the beginning and ending and averaging that, that's an approximation. Yeah. Okay. And actually, if you wanted the truly accurate thing, you'd have to have the asset base and the revenue or the profit for that day, you know, and like average that, you know. So yeah, but that'd be a complicated transaction. This is just trying to kind of illustrate an approximation. Okay, so the formula is you just take your total assets at the end of the year and average it with the assets at the beginning of the year. So that's kind of giving you some sense of what assets were employed during the year. It's again an approximation. And you're taking the net income and you're dividing by that. So in the case of the company with $1,000 of assets versus a million, let's assume that the asset base is the same, right? It's $1,000 at the beginning of the year and the end of the year, so the average is still 1,000. You would basically have, you know, the ROA for one of them would be 100 divided by 1,000 versus 100 divided by 1 million. So this is 10%, and this is what 1,000,000, 100,000, 1 in 10,000. So 0.01. Okay. So obviously this one is like a much higher return on assets. Okay. So, but this formula is trying to quantify that. You take the net income divided by the average assets, and that's going to give you some percentage return. Okay. So higher the better, right? We agree? We just see it here, right? Okay. Um, what else do we got to say about this? Any questions on this? Any clarifications? Any real life business? Really, there's some businesses that require zero capital. Okay. Um, if you're like yeah, I guess the plumbers, if you're like a consultant, you really don't need anything, and you can generate revenue, and you have zero asset base. So a lot of service businesses, this is like why service businesses are maybe considered better businesses, that you just need far fewer assets to generate uh, a profit. Okay.
How do they do the balance sheets?
For like a consulting business, real like large consult, they have office furniture and they have actual stuff. But yeah, their return on assets is very high. And Google used to be like that. They used to just be a software business, but now just like that, the CoreWeave business we saw, they have huge amount of property, plant, and equipment because they have all these data centers, and it's essentially like owning factories. You know, they spend billions and billions on physical infrastructure now, and that was not always the case. Before they just had that office space in Mountain View and not much else. Okay. Um, So let's move on to chapter two, which is building on chapter one. I think chapter one and two are pretty like related. Okay, so look, I'm I'm trying to hit on this accounting equation. We're gonna just review it because it sounds like some people are still a little shaky. So I'm gonna reintroduce the accounting equation briefly. We're now going to move into using debits and credits. Okay, so we're going to have that same exercise we did with all those transactions where we're like putting, like what went up and what went down, what account went up and down. But instead of using pluses and minuses, we're going to learn this system of double entry bookkeeping, which uses debits and credits. So we're no longer going to use plus signs and minus signs. Okay, everything is just going to be a positive number, but it's going to be a positive number that's either a debit or a credit. And we're going to talk about how this system works, how it's intimately related to the accounting equation. Okay, the system of debits and credits is organized by the way the accounting equation is organized. Okay, so this is just another layer of how integrated the accounting equation, assets equals liabilities plus equity, is in this whole system. Okay, um, and really, this chapter we're gonna work with this system of debits and credits with uh, practicing to do it with transactions. So the way we did it in that exercise that we did on Monday, we're gonna now apply the system of debits and credits to do that. Um, a trial balance, we're going to talk about what that is. That's basically a tabulation. So in the exercise we just did, we had all the balances for our accounts. So what I'm talking about is this right here. All these are account balances. And we use the balances to then make the financial statements, right? So the trial balance is going to be a tabulation of it's an organized form of this, but it integrates the system of debits and credits. So we'll see what that is. But really this information is what we need to make our financial statements, as we saw, right? Once you had this, it's just a matter of placing them in the right financial statement, and then you have your reports. These are the reports that you're going to share with your investors, right? So the account balances are the starting point to actually make the reports that's like kind of the point of financial accounting, is to come up with these reports. But in order to do that, we need to have the balances, and we need to have them organized, and we need to make sure that the accounting equation is balanced. And so the debits and credits, that system, a trial balance, these are all ways and tools that we use to make sure that at the end, our balance sheet is going to have this result. Okay. And then we'll talk about another ratio, the debt ratio, at the end. Okay, so look, the accounting equation. I'll say it again. I think repetition is a good way to learn things. This assets equals liabilities plus equity. It is a symmetry that is always holding at every moment after every transaction in the course of the business. Okay, when we have our balance sheet, that report, we are just saying we're having a cutoff date, December 31st of the year. Let's show that this balance is holding, okay? Because my claim is that even on September 13th, it's still holding, right? But in order to have like a report for our uh, business, like our financial statement users, we usually have quarter end, year end. These are like the cutoff dates where we are going to actually tabulate the balance and present it. Okay. Um, Assets, again, what is the definition? It's anything the business owns. So there is some confusion here. This is a good time to revisit this. Your business is spending money on stuff. It's spending money on PG&E bills. It's spending money on buying inventory. It's spending money on buying vans. How do we know whether it's a expense or an asset? They're both outflows of cash. So what is the differentiator? How do you know whether one is going to be appearing on the income statement as an expense versus an asset and it's going to appear on the balance sheet? What is kind of the differentiator? Who wants to explain it? It's written up there, but does anyone have like a straightforward way to remember this that they're using? Yeah.
For me, it would be if cash is paid, then it goes to um, the expense. If cash is retained, like you don't spend it, like any of those items, then it would be assets.
But I would spend money, like I can spend cash to buy inventory. Why not?
But it's you're not losing the cash. You're like
Converting it. But okay, but who is to say that when I pay my employee, I haven't converted it to something?
Not an account statement.
Yeah. What do you think, Kayla? Tangible, okay, but what if I bought a patent that I'm gonna have the right to some drug for the next 10 years? They're both transactions. When I pay my employees, that's a transaction. It's about future benefit, okay? The inventory I have sitting in my warehouse, I can return it and get cash back. I can sell it for a profit. I'm gonna get some future benefit from it, right? The salary that I pay to my employee is gone, right? Even though I paid them for last month, if I don't pay them the next month, they're going to stop working for me, right? So an expense is something that you've already used up and you're not going to get any future benefit from, right? Utilities, when you pay your utilities expenses, that's for energy you've already used, right? Uh, Rent, you're paying that after you've used the thing, after you've lived in the place. Um, so all this stuff is you're not getting a future benefit. That's really the thing to remember. An asset is something that you're going to get a benefit from in the future. Okay. So you'll get used to it. Okay. But I think this is a point of confusion as to like what is an expense versus an asset. And you need to figure out a way that you can keep this straight in your head because uh, there's like we talked about research and development, right? It's not always straightforward, right? Is research and development when your business spends money on that, is it going to get a future benefit? Maybe not, right? US GAAP says that you're not going to get a future benefit and you're just going to expense all of it. It's going to come out as an expense on your income statement. You may show a big loss, but the business may be like, no, well, really, we consider it an asset because we're going to get some future benefit from all this money we're spending, right? So most of the time, it's straightforward. Inventory, accounts receivable. Uh, when you pay for 1 year of insurance, you get a whole year of benefit, right? So that's an example of a prepaid insurance asset. Okay. Um, so yeah, so you really need to think about that. Just because you're spending money on something doesn't mean it's an expense. Okay, you need to think about what is an asset versus an expense. And you need to make sure you're clear about that. Yeah, Chris. Yeah.
It says something that will be present and future value. What if it was only future value, not present?
Um, yeah, it'd still be an asset. Yeah, like land, undeveloped land. A lot of real estate companies will land bank, they're just going to hold the land as an asset. It's not generating any income for them, but they're hoping that in the future it's going to appreciate or they'll be able to develop in the future. So yeah, that will certainly be an asset. Yeah. Did you have a question, Kayla?
What kind of not obviously had liability that right?
Yes.
Just that increase.
Yes. Yes. You're absolutely right. Yes. Principal, the amount you borrowed, that's going to be a liability. But it's like what is the interest? It's like paying rent on a house. The right to use that money, you gotta pay for that. So that's an expense. Yes, that's right. Okay. Again, what is a liability? It's anything your company owes to anyone else, and this can be uh, owing to the bank if you borrowed money. It could be owing salary to your workers because they're going to work for 2 weeks without pay, and then you pay them at the end of the 2 weeks. So you're technically borrowing from them for those 2 weeks. Your customers, in the case of an attorney who takes it a retainer, or an airlines who collects money up front. So these are just anything that you're going to have to pay out to some party in the future. Okay. And the common ones are accounts payable, notes or bonds payable, salaries payable, unearned revenue. That's like the airline where it takes money up front. Um, so these are all liabilities. And then the equity, this is where there's a lot of stuff going on in the equity section because really it's because the revenues and expenses are all coming out of the this section. Okay, so not only is it like, remember, you can consider this when you're buying a house like your down payment. This is money that you, as the owners, are contributing to the business out of your pocket. But it also includes the earnings of the business. Okay, how much it's bringing in revenue, how much it's paying out in expenses, and how much it's returning back to the shareholders. Okay, so you need to factor that in to the total equity. Okay, so let's see if you can fill this out. Again, this is going to be on the quiz. So see if you can, we just went through it. Make sure you can do this. Okay, go through the accounting equation at the top, fill out the first part, what equals what plus what, and then what is this broken out into, all the different components. Just make sure you can do this. And of course, it's nice that you memorize how to do this, but I want you to really think about the meta of what's going on here. How this equity, I'm just giving you a hint, how the financial statements are related, what we're actually doing to get to that balance. Okay, that like this framework is like like the this equation and this framework is like kind of what we're doing in the class. Okay, so you need like you should also not just memorize this, try to remember what they represent in terms of like the operations and the existence of the business itself. Okay, anyone need more time? Raise your hand if you need a little bit more time. Okay, everyone's good. Everyone's gonna get 100% on the quiz when this shows up, because it will. Yeah. Okay. Good. Okay. So, in case you want to just a little refresher, um, here's all the components. Uh, Again, I think making sure you understand the revenues and expenses at the bottom here. This is the income statement. You know how all this flows up, and eventually we get to the balance sheet. That's really the key thing to remember from all this. Okay. Um, yeah.
Right, Mr. Schleck, is to say that revenue minus expenses is the income statement, or would you just fill in blank?
Oh, for the quiz?
Yeah.
I don't remember. Yeah. Yeah, I think it's just filling in the blanks for the most part. Yeah, I think I do ask like something about the financial. Because really, I told you at the like the first week, one of the goals I want for all of you at the end of the class is to be able to look at financial statements, like know what they are and understand what's going on there. Okay. And this is the context. Okay. The income statement, you have to know where it fits into the balance sheet, where it fits into the kind of the whole scheme of the business, and this is kind of it. Okay, so um, I think it's important to understand like not just memorizing how it's going to appear on the quiz, but like what this means. That's going to be important when you have to like kind of contextualize what you're seeing in these financial statements. Yeah.
Or bonus stock and common capital the same thing.
Okay, so contributed capital, for the most part, how the form that it's going to take, at least when we're starting out, is common stock. Okay, so the way that most investors put money into a business is that they'll give cash to the business and they'll get some share of ownership, and that's usually in the form of common stock, right? But there's other types. There's preferred stock. Okay, that's another type of contributed capital. It's legally a little different than common stock. Uh, like Mark Zuckerberg, he has not the shares that trade of Meta on the stock market, which is like the common stock. He has a share class that has more voting rights. So it's like, the contributed capital is going to be there's going to be nuances to it, and it can be complicated. But for the beginning, how we're going to mostly be seeing it in this class at the beginning, especially, is just common stock, where the business takes the investors' money and gives them these shares of common stock in exchange for that. Okay? But yes, good question. Okay, any other questions on this? Okay, so the chart of accounts is a place where all the accounts that a business uses are listed. Okay, so you can see here. There's this accounting software. This is also a new thing I'm doing with you guys. Okay, I want to show you how this actually works when you're using it in like a commercial software. Okay, so um, when we get to that, I'll show you where the chart of accounts appears and like that. It's like QuickBooks. It's like a competitor to QuickBooks. But really, any accounting software, any accounting system is going to have a list of all the accounts that you're using. Okay, and not all companies use the same accounts, right? Um, like not like a bank is going to have a lot of different accounts for different types of loans that they give. Mortgage receivable and credit cards receivable. Those accounts are not going to be the same. Uh, they're not going to be relevant to like a construction company. Okay, so every business is going to have, first of all, like different needs of what accounts it needs, and also naming conventions. It's going to call things slightly different things. Um, there's discretion on what these are actually called and which ones are relevant. But as you kind of get more experience, you'll understand. Like Walmart and Costco will call the amount that they spend on their inventory two different things, but when you see their income statements, you'll be able to figure out this is cost of goods sold. We will call it cost of goods sold in this class, but each business is going to call it something slightly different. But if you conceptually understand what that is, then you'll be able to figure out what is kind of going on in a financial statement. And that, of course, takes experience and practice, but hopefully you'll get some of that from this class. So this is called a chart of accounts. You can see that it's arranged by, the assets are here, and it's going to have all the asset accounts, the liabilities, equity, um, and then this is part of equity. But since the revenues and expenses go on a separate financial statement, they're kind of giving them their own little numbering, numbers. Okay, because the income statement is maybe considered the most important financial statement because it's showing how profitable the business is. Okay, um, so the revenues and expenses are important. Investors want to be able to see uh, the details of the revenues and expenses. So there's usually some, there's a level of detail that's set up in the accounting system to be able to do that. Yeah.
Skip 131.
131. Where do you see that?
Or, I'm sorry.
Oh, yeah, I don't know.
Okay.
Typo. Maybe you can delete accounts too. So maybe there was an account there that they no longer use and they just got rid of it. Yeah. Okay. Any other questions on this? And I'll show this to you when we like start looking at that accounting software. Okay. Now this is kind of the lead up to our system of debits and credits. This system that we're using is called a double entry system. And this system is not obvious that it works, but it is like technology, I would say. It is a true like business technology. Whoever came up with this system was like, seeing the matrix. Okay, the fact that, and you're gonna see like you'll have 1,000 transactions. You're gonna use this system of debits and credits, and if you follow the system, at the end, the accounting equation will balance. It's freaking amazing that it works. Okay, so it was independently kind of came up with in different, there's different flavors of it, but Italian merchants in the 1500s, when India and the British were trading a lot, they had devised some system in the 1700s. The Middle East, Korea, in the regions that had a lot of trade independently have kind of come up with a similar system of double entry bookkeeping because it makes tracking transactions and account balances just like so much easier. Okay, and you didn't really need a computer. um, this is all in like ledger. People would like write stuff out and like keep columns, and you'll see how we're going to organize it. But it was really a system where you could keep your accounting books organized and in kind of like a coherent manner. Okay, um, there are uh, there are these cardinal rules. Okay, that you have to. These are something that you have to keep in mind at all times. You'll eventually kind of take it for granted, but I think it's really important to make explicitly clear what these cardinal rules are. Number one, in every transaction, there are at least two accounts involved. There can be more than two accounts, but there's never less than two. This is why it's called double entry. Okay. Every transaction has at least two accounts. So what is some examples? We talked about when you're issuing stock to your investors. What are the accounts involved? One is cash, because the investor is giving the company cash. What are they getting in exchange? Common stock. So there's two accounts involved, common stock and cash. When you perform a service for your customer, service revenue, and let's say they're going to pay you later, account receivable, right? There will never be a transaction that only affects one account. Okay, it will be two and sometimes many. We're going to see when we do like payroll, for example, there's going to be like 8 different accounts that we're going to have in one transaction. Okay, but there will always be at least two. Okay, the other cardinal axiom of this system is that your debits will always equal your credits, and we're going to see, this. It's going to make more sense when we kind of build the system out. But you can never have a transaction where the debits and the credits are unequal. Okay, so maybe you're going to have one account that's debited and 3 accounts that are credited, but the total debits and the total credits must always be equal for every transaction. And if you follow that cardinal rule, the crazy thing about this system is that at the end, your assets will equal your liabilities plus equity. And it's not obvious, but it's like if you get each little part right, the whole balances. And it's quite amazing that it works. Okay. These words, debit and credit, are totally arbitrary. We could make them left and right, and this system would still work. Okay. So there's no inherent meaning behind debit or credit. They literally kind of just do mean left and right. Debit means left and credit means right. Okay. We can see in this little diagram that for the assets on the left side, when they increase, that's what this up arrow means, you get a debit. And when an asset decreases, it's a credit. You can see the opposite is the case for liabilities, where if it increases, if you have a new loan or a new liability, it's going to be a credit. And if it decreases, when you pay off a loan, you would debit it. Okay. And the same thing with equity. So really, you can say that this whole side is debit and this whole side is credit. Okay, because when anything on this side increases, it's going to be a debit. When anything on this side increases, it's a credit. Okay, so this is actually related to the accounting equation. Okay, so I'm kind of writing it out here. I'm showing that on the assets, this is this is the left side is the debit up, meaning that anything on the left side of this equation, if it's increasing, it's going to get a debit. And then on this side, anything that increases is going to get a credit. Okay, so it would be pretty straightforward, except we have a couple of things going on here. This and these negative signs. right? So this liability, this contributed capital, revenue, they all follow this rule of increasing when there's a credit, or crediting when there's an increase. These two are actually the opposite because they're minus signs. So we can rearrange this. We can basically say assets plus expenses plus dividends equals liabilities plus contributed capital plus revenue. Right? I just added expenses and dividends to both sides, and that would cancel this out, and I moved it to this side. Right? So this is, I don't know, algebra, or I don't know when we learned this, like just messing with equations. All of these, when they increase, there's a debit. All of these, when they increase, there's a credit. This is how this system is arranged. Okay? So, for example, let's just do the example where my company is selling common stock to investors and getting cash. So is my cash going up or down after that transaction? Am I paying out cash or am I receiving cash from that transaction? My company is issuing stock, so investors are investing in my company. They're giving me cash, and my company is issuing stock to them. Cash is going up, right? So cash is what? What kind of account is it? It's an asset. So does that mean we debit it or credit it? Debit, okay? Because anything that's increasing on this side is a debit. So it'd be cash. Let's say it was like, I don't know, $1 million. Okay? So now what's the second account involved? What is the second account? This is again issuing of common stock. Contributed capital, right? So when contributed capital, what side is it on? Is it on the debit side or the credit side? Credit side. So contributed capital, we have these new shares that are coming into existence. So that's an increase in the contributed capital. So that means that common stock is going up. Since it's on this side, it's going to be a credit of 1 million. So this is kind of the debit. This is the credit. We have kind of columns. Okay. So this transaction, it's following our two cardinal rules. There's at least two accounts involved, and the debits equal the credits. Do you agree with that? Okay. So this is the pattern of the whole rest of our accounting system. This is the system of debits and credits. Okay. So this table, the book just presents this as kind of like a table, okay, where assets, when they increase, it's a debit, decreases the credit. Okay, but really, it's coming from this. It's essentially organized in the same way I just did it here. Okay, look, assets, expenses, and dividends all increase. All are debited when they increase. So let's just make sure that's the case. Assets, expenses, dividends, debit, debit, debit when they increase. Credit, credit, credit when they decrease. Liabilities, contributed capital, revenue, they all are credited when they increase. Liabilities, revenue, common stock, credit, 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 debit, debit, debit. So that's where this is coming from. Okay, so the table is there. If you memorize it, fine, but it's really just left and right. Okay, it's organizing this on the left side, credit normal on the right side, as we call it, credit normal, and it then puts these three here together and these three here together. Okay? So you're going to get a lot of practice at this, don't worry. Okay, so where do you hear? Okay, so let's just be clear on this. Where do we hear debit and credit in our lives? These words do exist. Where do you hear it usually? What context?
Credit card.
Credit card. Okay, what else?
The debit card.
Debit card. Okay. Thanks. Yes. Very good. So, what is so when you look at your bank account statement, are you happy when you see a debit or are you happy when you see a credit into your account?
Depends on the account.
Well, let's say your checking account.
Debit is good.
Why is debit good? Is your balance going up or down? When you debit? You sure? Why, when you use a debit card, who's absolutely confident that when their checking account, when you spend money, do you get a debit or do you get a credit? Debit, right? So maybe you think, oh, when my paycheck comes, I get a credit. That's good for me, right? So you may associate credit with good, or I get credit for my work, I get credit to my bank account. Uh, really, this is a function of this system, because what the bank is doing is that for them, your account is a liability, right? When you put money in a checking account, the bank owes you that money, right? They're borrowing from you. You put $1,000 in the bank, that bank is going to go loan it out to someone, but they owe you that money back, right? And they're paying you interest, if you have a savings account. So for them, what is that? Is that it's a liability. I just said it, so I won't ask you. So what happens when a liability increases? We just saw on this table, when a liability increases, it's a credit. And when it decreases, it's a debit. We agree? So when you go to your bank and you put in money, for them, that liability is increasing, right? It's a credit. In their accounting system, whatever, your account Patel, when I deposit money with them, what they're doing in their accounting system is that they're getting cash, whatever, $1,000, and then account Patel, which is a liability for them, is getting a credit. Okay, so when I get my bank account statement, and let's say I go to the ATM and I pull out $50 later. Okay, so let's say I did this on September 1, then on September 10, I go and I get cash out of the bank. Okay, my balance is going to go down, right? They no longer owe me as much money. So account Patel will get $50 of a debit because I've decreased the amount that they owe me because I'm taking money out, but they're losing cash. So they're gonna credit cash because cash is an asset, right? So we just saw here, when an asset goes up, when they receive my money, they debited it. When they're giving me my money back as cash, they're gonna have to credit cash because they're taking cash from Bank of America and they're giving it to me. So their cash balance is going down. Okay? So at the end of the day, when they give me my account statement, they're going to just pull all the instances of account Patel showing up. This one, and they'll say what was credited and what was debited. And so all the instances of me taking money out are debits, and all instances of me putting money in are credits. So it's really that whole debit and credit in your bank account is really just them tracking your account in their accounting system and then giving you the results. Okay, so there's no inherent good or bad. This is good for us because when we put in money, we get a credit. Okay. Um,
Actually, the banks don't say these words for accounts.
oh yeah. But they still call it a debit card. So it's like it's still there. And if you looked at the old bank account statements, they would say debits and credits. But yeah, yeah, yeah,
They call it a control or pass.
yeah. Okay, so I guess that's a good stopping place. We're gonna continue this and just practice this a bunch next week. So don't forget, your homework for chapter 1 is due Sunday. Your DSM is due tonight for chapter 1. And I think that's it. See you next week. Yeah, I gotta, I have those notes. Like, you know where to get the, but yeah, the slides I'll have to like do a whole, it's not going to be a whole process. It's going to take me a little bit. Yeah. See ya.